So let's head over to the Vanguard UK website platform and take a look at some of these different types of bond funds, and let's just try and figure out which ones seem to offer the best downside protection. So start off with the UK inflation linked gilt index fund. So these are UK government gilts that's meant to be inflation linked, however doesn't seem to be providing any protection whatsoever. What I've done with these funds is I've measured the recent peaks, so they all peaked around about the end of last year, beginning of this year, to the current price. So the inflation linked gilt fund has lost 24%, so more than 20% loss is an official bear market. The ETF, the VGov UK Gilt Bond ETF VGov, again just taking the same peak to trough here with the current valuation, that's lost 18%, and a similar UK government bond index fund. I think it's pretty much the same kind of makeup, but it's not an ETF, it's an index fund on the Vanguard platform. Here that's exactly the same. Yeah, the same kind of loss been seen on that one. There was a slight rally here. Well, not a rally, but a kind of leveling off for both of these funds as well recently. So when things started turning around, as they did globally, around about the sort of beginning of May, with yields coming down slightly and inflation coming down, so both of the yields and inflation kind of softening, you did start to see a bit of a leveling off, but today they've been selling off and there doesn't seem to be much protection being offered by UK bonds currently. So as ever in investing, the sort of universal principle of global diversification all seems to be the best way to minimize downside risk and volatility in a portfolio. It doesn't matter whether it's equities or bonds, same principle applies. So the globally diversified bond funds and the aggregate bond funds, which we'll talk about a little bit as well, these seem to provide better protection overall than particular countries' bond funds. So if we take a look at the global bond index fund, then again we've seen that downside slip down here to, let's have a look at this one. So this was down 10% recently, as opposed to like sort of between 18-24% for the UK bond funds. So it's done a lot better. If we just take a look at the price graph here, so you see that around about when things start to turn around early May, you're just seeing at least some price appreciation here, which you're not seeing in the UK funds. So we're getting better protection here basically. And on the ETF version, so this is an aggregate bond fund, so this is including things like corporate bonds, so you get even greater diversification, not just sort of government, not just US treasuries or government bonds, UK gilts. You're getting some mortgage-backed securities, you're getting some corporate bonds as well as the government bonds here. So and as we can see, this has also been offering the same kind of a little bit of price appreciation. Came down a bit recently today. Today's bonds were selling off again a bit again. But if we do see sort of global yields coming down as they started to, as we've seen with inflation starting to come down, so we may have passed the peak of inflation. We may well see these global funds start to appreciate and perform their traditional role of providing protection in bear markets, in equity bear markets. So yeah, that's aggregate bond fund, and that came down Yeah, it's about the same, 10 to 11%. And then finally, so the government index bond, so the index version, not the ETF version here, also came down around about 10%, slightly less, 9%. So again, we're seeing some sort of better appreciation here. This is actually from the US government bond fund, and government bonds all seem to be a little bit of a gold standard when it comes to these bond sell-offs. They're kind of seen as the main sort of flight to safety asset, really. So the US government bond index fund has done sort of relatively well, slightly better than even the global index funds that we've just seen. Again, you see a lot, but slightly steeper kind of price appreciation here, and it lost kind of just a little bit less volatile, so about -9% here. So that's done quite well. And as I say, if we do see a kind of flight to safety, US government bonds often see a lot of that capital or inflows coming in, particularly in an equities downturn. So, I mean, a sort of diversified strategy. I mean, you might have the global bond fund or the global aggregate bond fund, maybe 50%, and then a US government bond fund if you want to have something a bit more with a bit more of a conviction trade, as it were. Alternatively, just play it safe and just go for a global aggregate bond fund